Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And one of the first things that a new options trader learns about options is they carry leverage. When buying long options, they can carry a lot of leverage. However, I want to let you know that some options carry way more leverage than others. So today we're going to talk about how a trader who's seeking leverage might get much more leverage on an option. Really comes down to contract selection. We're going to be comparing options to stock ownership. A lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody who's chatting in out there in YouTube. Great to see so many familiar names, as always. Hello there, Eva and Lawrence, Josh and Ricebird, Robert. Who else is here? David, Sharon, everybody else. Thanks for joining us week after week and webcast after webcast. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. I always say that's a great way to watch these webcasts. But if you'd like to be here in the live stream, you're certainly invited to join us. This is a Tuesday webcast series. We kick things off promptly at noon Eastern time. We'd love to have you here as a live stream audience member. And as a treat here for my live stream audience members right now, my very good friend, Mike Fairborn, is joining us in the chats. Mike's going to be watching for any questions that come in that I don't get to. He's going to be picking up slack there for me. So thanks for having my back there, Mike. Mike and I have now been working together for years and years and years, and Mike brings a ton of experience to this. Thanks for being there, Mike. But guys, let's get into this discussion. And as we do, I do want to throw out an invitation for everyone watching or listening in. If you have an account on X, you should be following your favorite presenters from Schwab on X. You can find Mike on X at Mike Fairborn CS. You can find me there at Cameron May CS. You can also follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. So you can follow us. You can follow me on either of those platforms. And if you reply to one of my posts there, I try to reply right back to you. But getting into the discussion, of course, as we do, the first thing that we need to consider is the risk associated with investing and with trading. Do bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including the loss of principal. All right, so here, let's set an agenda for what we're going to be talking about today. First thing that we're going to do is just take a quick peek at what's going on with the stock market. We're going to look at the S&P 500 and allow that to frame a discussion of buying long calls where the trader is seeking leverage. Well, an important part of that discussion is understanding how much leverage is being delivered by which contract the trader selects. So we're going to use an example stock. We're going to look at an in-the-money long call and compare that to out-of-the-money long calls and just see how much leverage is accomplished through either one, for better or for worse. And we're going to plan and place a trade after we really understand the full extent of the leverage that we're exposing the example paper money portfolio to. So a lot to cover. Let's go right to the Thinkorswim desktop. And this is what's been happening with the S&P 500, looking at it through one technical lens. Let's see what's been going on as maybe our trader is looking out onto the near-term horizon, possibly contemplating trading a long call option. Well, what some technical traders note is that a previous price ceiling on the S&P 500, you can see how the S&P struggled to get above this rising price ceiling. Finally pushed up and through that in about the third or the fourth week of June. And since then, that's been acting as a nice price floor. And for some, when they see a trend established in an index or in a stock like that, their assumption might be that that trend is likely to continue until something else comes along that drives it in a new direction. But here we find ourselves recently pulling back, bouncing off that trend line, starting to bounce again, rising higher. And let's say that our trader's outlook is just, let's say that we assume that we're that we're going to continue moving higher. Now, obviously, time will tell whether that proves to be an accurate assumption or not. But maybe as the trader's looking out into the next few weeks, next couple of months, they're more bullish than bearish. So one option strategy that might be employed when one is bullish is buying a long call. So let's use an example stock for today's discussion. I'm going to be using Apple. Plenty of reasons why I chose Apple. For some traders, price per share can play a role. The liquidity of the stock can play a role. Illiquid stocks tend to have even more illiquid options. There can be issues with their pricing. It can be more difficult to trade profitably. Maybe the stock is in a new sector where they don't have exposure already. Lots of things that might motivate a trader to trade on a specific security. But one thing is what's been happening on the chart. Look what's happened with Apple. This is interesting. You'll see 4 lines here. You can see half of this last one. Really, all I did here is I drew one line and then I copied it and placed it in 4 different spots. Kind of interesting with Apple. Following this earnings back in July, price started to rise and it ran up about $32 in about 20 days. And then we pulled back, went sideways for a while, started to rise again, went up another $32 in about 20 days. Pulled back again, up another $32 in about 20 days. And then finally, we find ourselves where the stock is right now, which is recently we've pulled back, kind of channeled sideways. And let's say that our trader is just wondering, maybe we can get this to do that one more time. Maybe if price gets another tailwind, we can head up another $32-ish from these recent lows over these recent days. And that might carry us up to around, let's say, $300. Now, is this absolutely guaranteed to happen? Of course it's not. But a trader might use their charts to establish a premise and then try to leverage that premise through the purchase of a call option. So that's what I want to talk about today. Let's look at, first of all, let's compare 3 different strategies. We're going to compare just buying the stock to buying in what's called an in-the-money call, and then finally look at the out-of-the-money call. So let's start with scenario A. So here we have example. Ooh, let's make that bold. Back here. Let's make this bold. There we go. Example trade A, which is to buy the stock. Right? So let's say we buy 100 shares. Where are we trading right at this moment? Right around, okay, 272.70. Okay? Prices are going to change as we're talking. Let's just say that we're able to buy the shares for $272.70. And a trader never knows at the moment they place that order exactly the price that they might ultimately pay, especially if they're using something like a market order. But let's just say that we're able to place an order, we get it filled, $272.70. Now, let's say that after that, the stock decides to cooperate with our assumption. We buy at $272.70. And the stock runs on up to $300. So here's our assumption. Let's assume a couple of things. First of all, stock begins its journey and the stock rises $1. And later, we assume stock continues its journey and rises to our $300 target. All right, here's what I want to explore first. How much of a gain is made if the stock rises that first dollar? So we buy at $272.70 and it goes up to $273.70. Not much of a move. On a $272 stock, let's get our calculator out here. A $1 move on a $272.70 investment is about not a 3% return, but I'll round that up. Let's be generous. 0.4%. Okay. So that's approximately, let's write this down here, about a 0.4% return. It's a bold assumption that the Apple goes up $1, but I want to put this in in percentage terms, because that's going to be an important point of comparison when we look at the leverage that's being delivered by purchasing a long option. Now, before we move on to this second assumption, let's deal with this one. And I already know this is the target. I'm going to take off the word target just to give us a little bit more writing space there in that left window. In any case, a 1%, a $1 move is a 0.4% return-ish on Apple on that stock position. Let's compare that to a second scenario. Let me copy this. And let's say that our trader decides instead of buying the stock, they go to an example trade B and they buy a call option. Let's go to our trade tab. And as we look down through this option chain, we see that we can get into contracts that last just 3 days through the 14th of November. We could get into a contract that lasts 100 or 801 days all the way through the 21st of January 2028. Well, we just looked at a scenario where the stock has been moving up in spurts of about 20 calendar days. So maybe the trader decides, well, what I need to do is let's buy a call that gives me a window of opportunity that if the stock goes up for 20 days or so, maybe I have the opportunity to take advantage of that. Now, we could just buy a contract that's right around 20 days, but that might be shaving a little bit close. What some traders will do is they'll double the number of days that they feel that they actually need to complete their trade. So how about we go out here to the 19th of December, which is a 38-day contract, almost 40, about double, right? And let's say that we're looking at buying a call option for that December. Yeah, Paul says the December monthly. Let's look at a call option. And I think what we'll do, let's go back to our chart here. Stock is just starting to rise. It looked like our lows was around 265. Let's say that our trader is looking for leverage, but they want to go a little bit less leverage than maybe some other contracts. For our veteran options traders in the audience here, what sort of strike price, what sort of contract might the trader choose if they want to sort of reduce the leverage that's being delivered? This is still going to be a leveraged position. Yeah, our more veteran traders will know that going what we call in the money on those contracts is going to reduce the leverage. So let's say that trader A here, option trader A, decides to buy, let's say maybe the 250 call. That's right down here. And let's carry that on out through the 19th of December. So buying that 250 call is going to give this trader the right to buy shares for $250. But let's go look at the details of that trade. So instead of buying 100 shares, we're going to buy the 19th of December 250 call. That's in the money. And it looks like that might be, how much is that trading for? 25.05 to 25.15. Let's say it costs us $25.10. So explicitly, the trader is spending $25.10 for the right to buy 100 shares of stock. So that's $2,510 that's actually being spent, $25.10 per share times 100. That trader will have the right to buy 100 shares of Apple for $250 per share for the next 38 days. So if the stock goes on up to 300, hey, we got a nice discount. We can buy the shares for $250. There's leverage there in that trade. That's right, Eva, we're buying calls. That's exactly right. And yeah, you're suggesting out of the money. Yep, in this case, we're going in the money to increase that leverage. Well, how much leverage is being delivered? That's an important question. When I was first learning about options, I learned about this concept known as delta. It is a Greek. It can sound intimidating when we talk about it, potentially a different language, but I'll try to make this as simple as possible. All right. Delta can tell a trader some important things about their contract. One thing it can tell us is it can give us an estimate of the likelihood that that contract will expire in the money. Well, this contract's already in the money. There's about an 86% probability that this contract will still be in the money, or in other words, the stock will be above 250 at expiration. That's one potential interpretation of delta. But delta can also give us an important insight on how much leverage is being offered by an option. So look at that delta. It's about 86. It could change as we're talking. The market's open. These numbers are in constant flux. But remember the number 86. And let's talk about exactly what that means. Let's assume that our stock rises that same dollar. So we're comparing this to having purchased the shares at 272.70. The stock goes up $1. How much would our call investor make? Well, when I first learned about options, I thought, oh, so a call means we have the right to buy 100 shares. It's the same as share ownership. No, it's not the same as share ownership. But my incorrect assumption was that if the stock goes up $1, I must make $1 on my call contract. Not true. Here's how it actually works. If the stock goes up $1, so does that. Well, just keep the word dollar in mind. Dollar starts with D, so does delta. Our delta tells us how much that contract will increase or decrease in value if the stock rises or falls $1. So let's do some math here. If we buy that contract for $25.10 and the stock goes up $1 and it has a delta of 86 cents, that literally translates to an expected unrealized gain of 86 cents on our $25.10 investment. Or in other words, the contract would then be worth $25.96 from that $1 move on the stock. And you might think, wait a minute, I got ripped off here. Stock goes up $1, I only make 86 cents. Yes, but we didn't spend $273-ish to get into this position. We're only in this for about a tenth of that. So we got 86% of the potential return on that $1 move on about a 10%, even less than that, but around 10% in this case, investment. Let's see what that does to our percent return. If we go back up here to our calculator, if we get an 86-cent return on a $25.10 investment, it's not 0.4%. This is getting close to 4%. Yeah, almost 10 times the return. Think about that. $1 move on a $273 stock is a little tiny move. And yet that little tiny percentage move has translated to about a 3.5% return. In this case, I'm gonna put this in, let's move this out another decimal point. No, we don't need to use another decimal point. We can just say it's about 3.4% return. So that is a lot of leverage. Literally looking in the face of about a 9 or a 10 times 10x, 9x, 10x rate of return if the stock goes up. Now, obviously, leverage can work in both directions. If the stock goes down, this could be lost. Lose 3.4% on a tiny little $1 move on Apple. That's quite a bit of leverage, right? Now, I'll look at this third assumption in just a moment, but let's move on to another contract, because I think it would be easy to conclude here, unfortunately incorrectly, that, okay, so options offer 10 times as much leverage as stock ownership. No, some options do. Some offer less than that. Some actually offer a lot more than that. If we were to go deeper in the money, in other words, pay more money to have the right to buy the shares at a lower price, that greater cost on the contract is going to reduce the amount of leverage. Now, in the opposite direction, if we go further, let's say closer to at the money or even out of the money on these contracts, if we're spending less to lock in a purchase price, a contractual purchase price of the stock, that leverage actually goes up, and it can go up potentially dramatically. Let's do a little comparison here. Let's stick with a nice round 10 number. Maybe go for that 280 call. So let me copy this. And we're going to look at a third scenario, dialing up that leverage even further. So this is going to be example trade C, still buying a call, but the first one, we bought an in the money call. And on this one, let's buy an out of the money call. So let's look at maybe buying the 19th of December 280 call. Now the 250 costs us about 25 bucks, theoretically. That 280 call is only trading for a little bit over $5. Let's call it $5.40. So the expense of the trade just went down so this was about a tenth of the cost of the stock. This is only about 20% of the cost of that first call. As the cost goes down when buying long options, we could apply this same logic to puts. I'm just using calls for today's example. But as that expense goes down, the leverage goes up. Okay, so let's look at the same assumption. The stock rises just $1. Well, our delta, buying that 280 call, it is a fraction of the original delta. We have a delta of 40. In other words, if the stock goes up $1, we don't make $1. We don't even make 86 cents. We make 40 cents. Seems like the traders ripping themselves off here, leaving maybe 46, maybe 60% of the potential on the table. Yep, but we're getting 40% of this potential performance at a tiny fraction of the total cost. What is a 40-cent return on a $5.40 investment? That is a 7.4% return. So again, yeah, Paul says 40 cents on 540. So if we buy at 540 and the stock goes up $1, tiny fraction of a percent. The stock is hardly moving at all, and yet the leverage of this call contract has leveraged that return from a tiny fraction to 7.4%. That's getting up to about what maybe an average stock investor might expect from their portfolio over the course of an entire year. And yet this call contract just delivered that on a fraction of a percentage point move on Apple. So that's Paul, you definitely don't need to apologize. I definitely appreciate the back and forth here with my audience, because I like it when I can see, now Paul I think already knew this, but if the light bulbs are going off and we're really starting to gain insight into what I wanted to communicate today, that's important to me. So I definitely appreciate that. In any case, yeah, 7.4%. Everybody, let's set off the party, whatever, noisemakers and poppers and whatever else. This sounds great, but leverage can work in both directions. What if the stock just went down $1? Well, our 540 investments might slip to $5, and we just lost 7.4%, going the wrong direction here. So that is a lot of leverage, and leverage is not, the phrase that I use, it's not inherently virtuous. It's neither good nor bad. It just depends on what happens with the stock after that. Now, what I'm doing here also, some of you will probably notice, Cameron, aren't you ignoring what the role of volatility? Aren't you ignoring the role of time decay? Yes, I'm ignoring that for a very deliberate reason. I just want to keep the focus on leverage today. But if you're interested in learning about how a trader might use the Greeks for insight into the other variables that can influence the potential profit or loss of an options trade, you may want to check out a previous video that I've done on this topic. So do yourselves a favor. If you haven't subscribed to our Trader Talks channel on YouTube yet, do that right now. You can go down below the video stream and just click on subscribe. It only takes a second. It doesn't cost anything. But our YouTube channel is where we house previous webcasts, and that's what I want to look at today. You can also join the live discussions here, but let's use this keyword Greeks, because we're talking about Delta. It's one of the Greeks. I type in Greeks here. I recently did a video where I talked about all of the Greeks. Well, at least the ones that play a major role in the performance of options. So here are the options Greeks for beginners: Delta, Gamma, Theta, Vega, and even Rho. But today's focus is really just on Delta. I wanted to just give that more of a highlight. All right, let's see. John says, okay, let's see. Cam, we're only covering the first dollar move. We might want to remove the stock rises to 300. I don't want to remove that, Josh. I do want to address that. I just haven't covered it yet. Okay. But I did want to talk about how delta can give us some insight into the degree of initial leverage. The leverage actually changes over the lifespan of an option contract, but delta can give us that important insight. So if I were to approach a trader and say, okay, if you're interested in buying a call option, which contracts might that trader look to get more leverage? Well, now they would know, well, I can just glance at delta, and really, the lower that delta, the more leverage that contract is delivering. Now, obviously, it's doing some other things as well. It's giving us the right to buy the shares at higher and higher prices, which is not always great. It also exposes us to greater levels of time decay, as an example. So I don't want to say that leverage is everything, but it is the consideration that I wanted to talk about today. If I were to ask that same trader, well, how might a trader dial down the degree of leverage? Well, spending a little bit more money and buying a little bit deeper in the money contracts can reduce that leverage. But now let's go to Josh's question, or Josh's point here, not really a question, more of an observation. And that is, what if we get up to our target? Let's do some math there. If we buy the stock at $272 and it rises to $300, my math says that's a little bit shy of $30. It's going to be about $27.30 if I did my just mental math correctly. A $27.30. Ooh, that's going to work out kind of nicely. That's going to be exactly 10%. I can do that math. Let's pop up here. 27.30 divided by, I didn't intend that, it's just the way it worked out, 27.70 is 10%, just about exactly on the nose, right? So if our stock rises to $300 and we purchase it at $272.70, 10% return. Great. Now, this is where it gets a little bit more complicated because we have to understand the nature of delta. Delta is great for giving us an idea of the initial leverage of a contract, but it only gives us a hint of the leverage beyond that. Delta changes. As a matter of fact, look at what's happened to our delta since we started talking. It was 86, now it's 87. It has grown. The leverage on this contract is now greater than it was just a few minutes ago. And interestingly, what has happened to the value of the contract at the same time? We were looking at it for about $25. It's now about $26. What must have happened? Well, the stock just went up in price. Our stock has gone up from the prices we were viewing earlier, and that has increased its value. That's the way it works. Now, as that value of the contract changes, obviously, the degree of leverage for new investors in that contract is going to change, or the degree of leverage for those who already own the contract is going to change. Our delta changes. So if we start to look further down the line, I know how much delta is on the first $1 move, but after that, it gets a little bit hazier. If we're looking at a $27 move, we might need a calculator to help us with that. So I'm going to use a calculator. It's built right into Thinkorswim, right up here where it says delta theta vega. That's our current column set. I'm going to exchange these Greeks for a calculator that gives us a little bit deeper look into those Greeks. Let's switch this to something known as Theo price. This is a calculator that allows us to enter assumptions about the stock, about where the stock moves and how long it takes to get there. And then it converts those assumptions, it runs a calculation, it tells us the impact of those assumptions on our investment. So, yeah, Robert says gamma effect on delta. Exactly right, Robert. I made a very conscious decision to not get deeply in the weeds of gamma today. Instead, just know that delta changes as stock price changes. It can also, well, it changes in relationship to the value of the option contract, and our other Greeks are playing a role. So when we're just looking at a $1 move, we can just use delta. If we're looking at a multi-dollar move over a span of time, might be better to just use a calculator. So for this case, we're going to use that Theoprice calculator. And once I've loaded that up into my column set, so there's our Theoprice, I can now click on the calculator to the right and just plug in some assumptions about our stock. So what were the basic assumptions of the move that we were expecting? We were thinking that from recent lows, maybe the stock goes up about 32 bucks. It's already gone up some distance. How much distance does it have to go from where it is right now? Well, let's just leave it at 270, 270. Sorry, that has a sort of a awkward rhythm to it. 272 and 70 cents. Anyway, let's say that we go up that extra $27.30 up to our $300 target. So this is where we're addressing this. We already know that's a 10% return on the stock. Well, what's the return on our 2 options contracts? Well, our calculator here can generate that anticipated return for us. First thing we need to do here is build in price. Build in time. So if it takes 20 days to move up from recent lows, that would put us out 1, 2, and let's go out to December. That would be maybe that first or the second Monday in December. Is that going to be 3 weeks, 21 days? No. That'll be that first Monday. That's about 20 days out. Yep. There we go. So we built in the time decay into these contracts, but we also anticipated the stock might go up $27.30. And I'm not going to make any assumptions about volatility today. Let's just make those 2 assumptions. Stock goes up to 300 bucks and does that over the course of the next 20 days. Well, now as we look at this Theoprice column, this is now adding in the leverage. It's also subtracting the time decay, and it's kicking out a final expected value for these 2 contracts. So this contract that we originally purchased for about 25 bucks is worth about $50. Well, let's just do some rough math there. That's about 100% return. So our 10% move on our stock has produced about a 100% return as the stock rises to 300 bucks. What about this out of the money contract? That contract we bought for $5-ish would be worth over $21. That is about 4 times the value, or about a 300% return. Let's be a little bit more precise here. So let's say that it's worth $21.60. We originally bought it for $5.40. So $21.60 after our anticipated move minus the $5.40 investment is a $16.20 gain. This is obviously theoretical, but accurate under those assumptions. If the stock were to move up to $300, or move up $27.20 or 30 cents in 20 days, this would be the expected value of that contract. So $16.20 gain on a what was it? We paid $5.40. That's a 300, actually spot on, 300% return. Worked out those numbers. I didn't plan these to be this round, 10% here, 100% there, 300% there, but it still makes my point. I think it puts a highlight pen stroke across my point. Those out of the money contracts offer a much higher degree of leverage. Now, obviously, if the stock misbehaves, that leverage works in the opposite direction. And the losses can pile up very quickly on these out of the money contracts versus less quickly in the money, and less quickly still on just stock ownership. Let's see. Hill O'Keefe says, are we assuming the Theoprice is on a long call or a put, or as opposed to a short? Yeah, so Theoprice just implements anticipated moves in price and time, and we could have also moved volatility. We chose not to here. Just a basic assumption. What happens if the stock goes up $27.30 over 20 days or by December 1st? And that tells us the anticipated future value of each of our strike prices for calls. It would also, yes, we could look over here and look at the puts. So if someone who had purchased a put would expect to lose money. Time decay and the stock moved in the wrong direction, puts will have lost value. Yep. Oh, I'm looking at the mark. Theo prices here. In any case, yeah, these puts got decimated by that same bullish move on our stock that was so rewarding for call ownership. So this is a nifty little tool, this Theo price tool. It can provide, again, deeper insight into the degree of leverage that's offered by different contracts if we understand how it might be used. All right. So guys, which one are we going to trade today? I thought since the purpose of today's discussion was to emphasize, where greater leverage might be accomplished, for better or for worse, let's go with this out of the money contract. Now, as I go to place this trade, that leverage can have important implications as well for the way that the trade is managed. A stock trader who buys the stock and the stock goes, let's say the stock just drops a few bucks, it might be inconsequential to that stock trader, generally speaking, and it might be far away from, let's say, a stop level, depending on the way that they prefer to trade. But a small move in the stock, $3 move is barely 1% of the stock value. $3 move on this in the money contract, that might be a 10% gain or loss in the case of a stop. A $3 move on this contract, it might be somewhere on the order of a 20% loss. Now, the bottom line here is a trader who's buying the less leveraged contracts, maybe they can get away with a tighter stop. Because a move on the stock might not produce as dramatic a move to the downside on their option contract. So let's say for in the money contracts, for example, maybe a trader uses something like a 30% stop. Now, not everybody's going to use that, not on every contract, but as we go at the money or out of the money, maybe the trader uses looser stops to accommodate for that additional volatility that is inherent to those at the money or out of the money contracts. So where they might get away with a relatively tight stop in the money, like a 30%, maybe at the money, they might loosen that up to possibly a 50 or a 60%. Going out of the money, maybe the trader just says, hey, I'm willing to risk the entire invested amount. Maybe they don't use a stop. So in this case, we're not going to place a stop on this trade. Not every trader is going to agree with that approach, but just know that that high degree of leverage that's available on those out of the money contracts can magnify relatively small moves on the stock and cause lots of stops to get hit, especially if the trader is using relatively tight stops. So let's go ahead. How do we place the trade? We just click on the ask price. Click on the ask price of the 280 call. By default, this is going to bring up an order for 10 contracts. That would be around, at this point, $565 for one contract, around $5,650 on 10 contracts. How about for this example? Let's just go ahead and let's lock that in. Put this in as a limit order, $565. Let's click confirm and send. We would be offering to pay $565 as our limit, the maximum that we're willing to spend here. To buy 10 contracts, that would be $5,650 invested and risked, plus commissions of $6.50, and we can send that order off. CBA 82, do you plan exits based on the movement of the stock price or the option price? Can be done either way. Yep. We could make it conditional on the stock price falling to a certain level, or we can make it based on the value of the option contract. So for example, if our trader is investing $565, let's just say they're okay with risking that leverage might take them out, and putting in a stop at half of that value. Maybe they put in a stop at around, what would that be? Around 270-ish, something like that. So it can be, or more like 280. But it can be based on either one. In this case, I'm just going to choose not to put a stop on this at all, just to emphasize that the leverage that's inherent to these contracts may lead some traders to say, even putting in a stop might expose us to a risk of a whipsaw event taking us out before the trade even has a chance to get to its target. Paul says the target of 2 delta. We didn't use delta in establishing this target, but as a matter of fact, it would be, if we were to get there, the anticipated return would be a quadrupling of the value of this contract. Time will tell if that's what's happened, if that's what's going to happen. But we could just send this order off. I'm not going to do that today. I just wanted to walk through how the order might be placed. I'm not going to add that to an example portfolio. This was just for illustrative purposes only. But that has, I think we've accomplished what we set out to do today. Today was all about the leverage that's available on contracts. So I wanted to address, here's how to get much more leverage on the purchase of a call contract. And I think we've done that. So hope you found that interesting, entertaining, maybe educational, hopefully. Yeah. But this is what we do with our Tuesday webcast series, Getting Started with Options. We talk about important things like the degree of leverage that's available on a contract, and we'll pick a new topic next Tuesday. I hope that you'll have a view of that video as well. I'm going to let you go enjoy the rest of our educational offerings through the rest of the day. We have lots of webcasts still in store through the rest of the day. But as I let you go, I want you to be aware of all of the educational resources they have available through Schwab Education. Starting with, first of all, if you haven't subscribed to our Trader Talks channel on YouTube, make sure you do that. You can just go down, click on the subscribe button. Doesn't cost anything. It only takes a moment. But our Trader Talks Schwab Coaching Webcast channel on YouTube is where we house our playlists of completed webcasts. You can join our live streams here. You can also do searches through our archives for topics of specific interest, like maybe the Greeks. Another thing that I want to make sure that you are doing is that you're following your favorite Schwab presenters on social media. You can find Mike Fairborn on X at Mike Fairborn CS. You can find me on X at Cameron May CS. So there's my handle right there. And if you reply to one of my posts here, I try to reply right back to you. But you can also follow me on LinkedIn. So let me show that to you. Here's my LinkedIn. LinkedIn, one thing that I like about it is it allows me to make bigger posts, longer posts with more detail. So if you reply to one of these posts, I can reply right back to you. 108 people are my followers right now. I just started doing this 3 weeks ago. So you can follow me here on LinkedIn. To find me, just go to linkedin.com/Cameron May CS. So that's it. LinkedIn.com. I'll put that. Let me put that in the YouTube description for this video. Okay. But that's how you can track me down. I've had people ask me, how do I find you on LinkedIn? They get on here and they look for Cameron May. They can't find me. LinkedIn.com/Cameron May CS. You don't need to put in the rest of this. That's just to take you to my feed. All right. But everybody, thanks for joining me today. I will look for you in future webcasts. I also want to say thank you for everybody that's already clicked the thumbs up. I can see 150-ish people watching, and 61 have already clicked the like button out there on YouTube. That's very much appreciated. It's like a pat on the back to your presenter, but it also gives a boost to my video, and the YouTube algorithm helps more people find these sorts of discussions about important topics like the degree of leverage offered by a contract. So yeah, if you'd always make a habit of just clicking that like button if you've enjoyed one of our videos, it's always helpful, always appreciated. Never costs anything to do it. All right, everybody, go enjoy the rest of our webcasts. I'll look for you in future webcasts of mine. I'll also look for you on social media, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.